Now, Lou, you've got some really fascinating slides about more research. It's about data, right? Research about how much we could afford to take out with different kinds of platforms. So please walk us through this. This is fascinating stuff.
Right. What I think is really interesting, RJ, is even though the market over time goes up and to the left, here's a slide that's showing almost over 100 years of data. And you can see the markets do really great. They average here over 9.1% average annual rate of return. But we forget about bear markets. And in between this great mountain slide, you see these periods of red that show the markets went into some form of a depression or a recession. And that brings up the question that clients ask, which is, how much can I take from my portfolio every year in, let's say, a standard 30-year retirement? And the standard recommendation is 3 to 4%. The 3% is more for like the S&P 500. This is they come up with these recommendations based on math. They use Monte Carlo simulations, which just takes a portfolio like the S&P and it runs it through thousands of simulation, maybe the best years first, the worst years last, the worst years first, the best years last. They take all of those thousands of scenarios, they mix them all up, and they come up with a ranking score that says what probability or what safety probability can we expect to take out a specific percentage and make it to a 30-year retirement. So for stocks, it's around 3%. Now, not everyone retires and goes into an all equity portfolio. So to the right here, we're showing a balanced portfolio, someone that's mixing stocks and bonds. And the recommendation there is 4%, which brings us back to the 3 to 4% standard recommendation for how much you can take out in retirement. But remember, Beacon eliminates the catastrophic loss years in the portfolio when invested in equities. So this slide, if you go to the fifth column here, there's the S&P 500 we talked about, a 97% safety ratio if you limit your withdrawals to 3%. But if we go here apples to apples, the fourth column, Vantage Aggressive 3.0, this is an all equity portfolio. We're able to take 5% distribution with 96% safety. And apples to apples, as we mentioned, the 60-40 portfolio, which was a 4% safe withdrawal, we can use our balanced here, which is apples to apples. We can take 5% of that portfolio. So we're talking about a 25% increase in income solely by having a risk management scenario in place to protect clients from catastrophic loss.
Fantastic. And I just want people to realize, once you start getting into income, and probably many that are watching this video or videos, you're not at that place yet. You haven't started taking a retirement income yet. So you've got maybe some time to make up for some losses. But the point of it is, why go into the ditch anyway? If you don't go into the ditch, you don't have to call for the tow truck. And that's the brilliance of the Beacon strategy, is limiting the losses, but at the same time, in the opportunities where there's an upside draft going on, like right now, where the equity markets are overall doing quite well, we can have sort of the pedal to the metal. Now, my portfolio, I use the aggressive allocation. My wife, who's extremely cautious, but surprisingly, she's in the balanced, where up to 70% of the allocation will be in equities when times are good. But when times get rocky and there's that 10% drop from the high watermark, from the spot where that basket was the highest, when that pulls back by 10%, then the portfolios that are in equities go into all bonds. And right now, for the most part, that is U.S. government treasuries, very short maturities. They're constantly rolling over. And because the Federal Reserve is keeping interest rates higher and plans to for some time, according to the Fed chair, this is a great time for us to get nice returns with very, very, very little risk, because it's, for the most part, invested in U.S. treasuries.